If you invest $10,000 today, the standard mathematical models suggest that over the next 20 years, your capital follows a path that looks exactly like this, ultimately reaching over $92,000. This frictionless, ever-accelerating upward sweep is the standard projection of compounding. It is the baseline expectation sold to every retail investor. But if you subject that same $10,000 to the actual financial markets over that exact same 20-year period, the journey looks like this. Look closely at the terminal point. Despite the violent, unpredictable path, the real-world portfolio arrives at the exact same $92,664 mark. We are taught to view wealth accumulation as a deterministic process, a reliable engine where capital steadily accelerates without interruption. Yet in active financial markets, a perfectly smooth exponential curve is a mathematical fiction. The financial industry bridges this gap between expectation and reality using a metric called the compound annual growth rate, or CAGR. CAGR is not a predictive law of physics. It is merely a backward-looking smoothing function designed to make historical chaos look orderly. Real-world compounding is a high-variance, stochastic process. It is governed heavily by volatility, not by a steady, comforting mathematical rule. This visual disconnect suggests that our understanding of wealth is often built on an idealized model that the market has no obligation to follow. To understand why this mathematical illusion is so persistent, we have to look at the mechanical first principles of compounding. A base of $100 multiplied by a 10% growth rate yields $10, creating a new base of $110. The critical mechanic here is the shifting base. In year 2, that exact same 10% rate generates $11. The rate remains static, but the total mass of the capital increases. As we run this through several more cycles, the compounding momentum builds. Every iteration applies the static rate against a heavier base. The absolute dollar return climbs steadily higher, even though the percentage rate itself never changes. When this exact geometric progression is scaled out to 200 periods, a visual paradox emerges. For the first 130 periods, the line appears completely flat against the axis. On a multi-decade scale, the early years of compounding create an optical illusion of total stagnation. The underlying math is functioning perfectly during this entire stretch. The absolute numbers are simply too small to register visually until the expanding base reaches a critical mass. This visual trick translates directly into a psychological trap. Investors routinely abandon their strategies during this waiting period because they mistake low absolute returns for zero progress. But this first principles demonstration contains a critical structural flaw. It operates in a perfectly sterile environment, totally isolated from real-world market interference. The entire model relies on the assumption of a constant, uninterrupted positive rate of return. While the expanding base model is mathematically flawless in a vacuum, its assumption of constant growth renders it dangerously inadequate for predicting human endurance in chaotic markets. To stress test this theoretical framework, we need empirical data. We will track the monthly returns of the Nifty 50 index from the year 2000 through 2020. This is the raw output of institutional capital allocation over 2 decades. Mapped out month by month, the reality of market returns looks like this. The constant growth rate is entirely absent. Instead, we see positive months aggressively intermingled with severe negative contractions. Tracking our initial $10,000 investment into January 2000, we see an immediate return of 4.44%. The base expands. But by March, negative variance attacks, delivering a drop of 7.64%. In a stochastic environment, a negative rate actively destroys the mathematical base that took months of positive returns to build. If we move the timeline forward to the year 2008, the true mechanical stress test occurs. During the global financial crisis, extreme negative variance fractured the systemic foundation of the markets. By the end of that year, the index recorded a 51% portfolio drawdown. A 51% drop erases years of accrued base expansion in a single sequence, liquidating growth that took half a decade to accumulate. Recovering from a hole that deep requires violent mathematical oscillation. To merely mend the damage of the 51% loss, the subsequent year demanded a 75% positive return. These terrifying swings are not anomalies. They are the required price of admission for long-term capital growth. The true mechanical driver of long-term wealth accumulation is not calculating the perfect interest rate, but possessing the psychological stamina to survive high-variance market shocks. Returning to the terminal outcome of our 20-year journey, we find that despite the crashes, the initial $10,000 survived to reach $92,664. The financial industry uses one specific mathematical formula to summarize this entire terrifying sequence. When we plug our empirical starting and ending numbers, along with our 20-year time frame, into the equation, we get a final rate of 11.78%. This 11.78% is the theoretical constant rate that would have been required to reach the final sum, assuming a universe with zero volatility. But when we superimpose that mathematical theory directly over the empirical data, the gap between the formula and the lived reality is exposed. Look at the vast empty spaces between the theoretical curve and the real-world drawdowns. The smooth curve forces a false historical narrative. It implies a reliable, incremental progression year over year. The data proves the actual path was an unpredictable, psychologically taxing sequence of rapid gains and severe capital destruction. The smooth CAGR curve is merely a retrospective analytical tool, a way to translate decades of chaos into a digestible, easy-to-sell number after the fact. The power of geometric returns is not found in the certainty of the formula, but in the investor's capacity to endure the severe variance of the stochastic path. Intuitively grasping wealth accumulation requires abandoning the expectation of a smooth ride and fully accepting the chaos between the starting point and your terminal wealth.